Oh, bonjour tout le monde. Good morning, everyone. My name is Paul Bodicher. I am the Director of Media Relations here at the Bank of Canada, and I'll be moderating today's press conference about our financial stability report. Governor Macklem and Senior Deputy Governor Rogers will be pleased to take questions until roughly 11:40. The Governor and Senior Deputy Governor will start with some opening remarks, and after that, we're going to go to your questions. Alors, Monsieur le Gouverneur, à vous la parole.
Thank you, Paul. Good morning. I'm very pleased to be here with Senior Deputy Governor Carolyn Rogers to discuss our financial stability report. Part of the bank's mandate is to preserve and promote the stability of the Canadian financial system. A stable and resilient financial system means people can access credit and manage their assets safely and predictably in good times and in bad. It also reduces the need for authorities to intervene in periods of financial stress. In short, a stable financial system is critical to Canada's economic well-being. Chaque année, la Banque publie ce rapport pour évaluer la stabilité du système financier canadien et souligner les risques qui menacent cette stabilité. Pour que l'objectif soit clair, la revue du système financier s'appelle maintenant le Rapport sur la stabilité financière. Le système financier canadien est fortement interconnecté. Les tensions dans un secteur peuvent affecter les autres secteurs. Le rapport met donc l'accent sur les risques pouvant toucher tout le système financier et menacer sa stabilité. Le rapport est axé sur les risques liés à l'évolution de l'économie. On regarde les risques pouvant mener à des tensions pour le système dans 4 secteurs clés: les ménages, les entreprises, les banques et les institutions financières non bancaires. Il y a aussi des risques importants de nature opérationnelle ou structurelle, comme les cyberattaques et les risques liés au climat. D'habitude, ces risques sont abordés dans le portail sur le système financier de la banque. Mais en cas de changement majeur, on peut aussi en parler dans le rapport. Alors, quels sont les messages clés du rapport? Le premier est que le système financier canadien demeure résilient. Depuis un an, les ménages, les entreprises, les banques et les autres institutions financières ont pris des mesures proactives pour s'adapter aux taux plus élevés et résister aux chocs économiques. Le deuxième message est que cette adaptation n'est pas finie et pose encore des risques pour la stabilité financière. What are the key messages from today's financial stability report? Well, the first message is that Canada's financial system remains resilient. Over the past year, households, businesses, banks, and other financial institutions have taken proactive steps to adjust to higher interest rates and weather economic shocks. The second message is that this adjustment still has some ways to go and continues to present risks to financial stability. I'll offer some context around this assessment, and then the Senior Deputy Governor will touch on the risks in different sectors. Over the past year, the risk of recession has diminished in Canada and globally. Inflation in most countries has come down, and inflation targets are in sight. However, there could be volatility in markets as expectations shift about when and by how much central banks will lower their policy rates. And there continue to be important geopolitical and economic risks on the horizon. Against this backdrop, households and businesses continue to adjust to past interest rate increases. Some indicators of financial stress have risen. At the same time, the valuations of some financial assets appear to have become stretched. This could increase the risk of a sharp correction that could generate system-wide stress. The recent rise in the use of leverage in non-bank financial institutions could amplify the effects of such a correction. What's most important is that to properly manage risks, financial system participants need to remain proactive, and financial authorities need to remain vigilant. Le plus important, c'est que pour bien gérer les risques, les participants au système financier doivent rester proactifs et les autorités financières doivent rester vigilantes. With that, let me now pass the floor to Carolyn.
Thank you, Governor. I'll touch on each of the sectors that we cover in the FSR. I'll begin with households. So far, most households have proven resilient in the face of higher interest rates and inflation. Overall, we've seen households adjusting to higher debt servicing costs. This does not mean that this adjustment has been easy. Clearly, there are individuals and families who are feeling very stretched. What we're evaluating in the FSR are the indicators of overall stress in the system. Some of the indicators of household financial stress that fell during the pandemic are back to or above normal levels. Survey data suggests that renters are experiencing the biggest increase in financial stress. After hitting historical lows during the pandemic, the share of households without a mortgage that are behind on credit card or auto loan payments has come back up to or surpassed typical levels. And over the past year, the share of borrowers without a mortgage who carry credit card balances of at least 80% of their credit limit has continued to climb. Among mortgage holders, indicators of financial stress have remained relatively low, even as many have been coping with higher mortgage payments. Since the bank began raising its policy rate in March of 2022, payments have increased for roughly half of outstanding mortgages. Over the next 2.5 years, most of the remaining mortgages will renew, and these borrowers are likely to face relatively higher payment increases. At the same time, many mortgage holders have also seen their wages go up. Some have proactively adjusted their spending to help offset higher debt payments, and many also report higher levels of savings available to offset increase in payments. Overall, the evidence suggests that households have the flexibility to continue servicing their debt at higher rates. We will be watching the data closely for signs of increased financial strain among households, both mortgage holders and non-mortgage holders. We'll also be watching how the labor market evolves, since the biggest factor that determines whether someone can service their debt is if they have stable income. Higher interest rates are also affecting businesses. Higher rates are slowing demand for the goods and services that businesses sell, while also increasing their financing costs. So far, the financial health of large businesses appears solid, but smaller businesses are showing more signs of financial stress. Insolvency filings by smaller firms have recently jumped after several years of being below average. This is an indication that recent increases could be catching up or normalizing, and the timing could be driven in part by the expiry of government support programs that were put in place during the pandemic. Turning to Canadian banks, overall, credit performance is strong. Banks are proactively contacting customers who are facing payment increases at renewal and working with them on a payment plan. They've also been putting more money aside to cover future loan losses, and they continue to maintain healthy capital and liquidity buffers. This means that even if financial conditions or credit performance deteriorate, banks are positioned to absorb losses and continue to provide credit. In the non-bank financial sector, more frequent volatility in financial markets in recent years has led to an increased focus on liquidity risks. At the same time, some firms are increasingly using leverage or borrowed money to fund trading activities. This makes them more vulnerable in the event of large market swings. Let me close by repeating an important point that the Governor made at the beginning. The connections in the financial system mean that if risks materialize in one sector, they can spread quickly. This puts a premium on preparedness. Les mesures proactives des participants au système financier ont été positives et elles doivent continuer. Un système stable et résilient profite à tout le monde. Le gouverneur et moi allons maintenant répondre à vos questions. Governor and I will now be happy to take your questions.
Thank you both. Before we get to the questions, I'm just going to remind everybody how this is going to work. I have a list of reporters here in Ottawa at the bank. I've got a few on the line as well. I'm going to start here in the room and then go to the phones. Given the numbers that we have, we'll have one question and one follow-up. If I forget to do so, please state your name and affiliation. And I'll remind you respectfully that the topic of the day is the Financial Stability Report. Our next scheduled press conference for monetary policy is less than 4 weeks away. Avant de poser une question, veuillez vous identifier et si je ne l'ai pas fait, et comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's go to our first question here in Ottawa, and I'm going to go to David Lundgren of Thomson Reuters.
Yeah, good morning. You mentioned a surge in small business insolvencies. What are the implications of the broader economy of that surge?
So we go into that in some depth. There's a box one actually in the report digs into this. A couple things I would highlight here in getting to your question. So as the report highlights, we have seen quite a sharp increase in bankruptcies of small businesses. These are quite, in general, I mean, there's a range, there's a distribution, but in general, they are fairly small. Some of this looks to be, I guess, call it catch-up. We went through a period of very unusually low numbers of bankruptcies through the pandemic. Interest rates were at emergency low levels. There was a whole range of government support programs. Obviously, interest rates have come up. Government support programs have ended, and they need to pay back. In one case, for case of one program, they need to pay back the money. So you have seen a big increase. One way to see that some of this is kind of catch up from unusually low. If you look at the sectors that were where bankruptcies were particularly low, those are the sectors where we've seen the biggest increase. So it does suggest there's some catch up. And if you look at the most recent data, it is starting to come back down. So that is something we're going to be looking at very closely. If it is catch up, you would expect it to go up, and then you'd expect it to come back down. If it continues to go up or doesn't come back down, certainly it's going to be a bigger problem. In terms of how big a problem this is overall, obviously it's a big problem for these small businesses. In terms of the broader economy, if you look at other data, for example, StatsCan has data on business openings and closures. Bankruptcies are a very small percentage of business closures, like less than 5%. So, in other words, businesses close for many other reasons than bankruptcy. And if you look at business closures overall, they're at pretty normal levels. And similarly, business openings are pretty normal levels, and they're slightly above business closures. So there's more businesses opening than closing. So from a macro perspective, we don't see a big implication for this. And if you look at, in terms of the impact on banks, you can see, I don't know what, there's a figure in the report, I can't remember the number, but it shows that banks' delinquencies from commercial loans are pretty low overall.
Thanks. And secondly, there's a box about basis trade. Is there a level at which you would consider steps to limit growth in basis trades, given the risk of financial stress if these trades are unwound, kind of suddenly?
This basis trade is doing a couple of things. It's providing additional liquidity to the market. It's narrowing the discrepancy between the bond and the futures. So that provision of liquidity, that that arbitrage is actually helpful to markets. However, we do express some concern that basically the way you make money you don't make very much money on any one trade. There's a small discrepancy. You make a small amount of money. So in order to make this worthwhile, you need to do a lot of it, and to do a lot of it, you need to borrow. And we've seen an increase in borrowing, particularly in repo markets of hedge funds. And in the event that there was a sudden repricing, a sudden change in bond prices, big change in yields, there could be a situation where either because of margin calls or a need to unwind those trades, they could have to sell the bonds into a weak market, and that could really amplify the market swing. So there is some, we highlight this, I'd say, relative to last year, this is one of the things that has changed. We have seen more use of leverage, and that is increasing vulnerability. And really, by highlighting it, our hope is people will manage this risk better.
Maybe I'll just add to the governor's comment. We don't necessarily aim to limit the type of trade, but rather to make sure that the institutions that are making these trades are adequately margining for them. So making sure that there's a buffer. You can margin both on the short end and the long end of the trade. There's a variation margin, initial margin. So I think that's where the focus, this is not a new risk. The global financial sector has been focused on this risk for some time. It's a little bit newer in Canada. But there's been a lot of work done on this, and really the best way to mitigate the risks is to make sure that there's adequate margin there, so that if there is a swing, there's something to buffer the price changes.
Okay, next up I'm going to call on Jordan Gowling from CTV.
Hi, your report indicates that half of mortgage holders are set to renew in the next few years, and that those borrowers can expect large average increases in their monthly payments. How confident are you that households will be able to handle that, especially when I think the chart indicated that some mortgage holders could see their monthly payment increase by as much as 60%?
So let me, in answering that question, there are households in very different situations. And if you look overall, what you see is households are adjusting to higher interest rates. Some are adjusting better than others. If you look at, I'm going to start with non-mortgage holders, and there we have seen a rise in financial stress. And the survey of non-mortgage holders includes two broad groups: renters and people who own their house outright. Survey evidence suggests that the stress is more concentrated in renters. In contrast, if you look at mortgage holders, indicators of financial stress actually have changed very little and remain quite low. So let me just unpack that a little bit, and then I'll get to the going forward. So one way to look at, some good indicators of financial stress are people keeping up with their credit card payments? Are they keeping up with their auto loans? If you look at renters or non-mortgage holders, what you see is their credit card arrears and auto loan arrears were very low during the pandemic. They've been rising, and they're now generally somewhat above pre-pandemic levels. And so what we are seeing in that segment of the household sector, there is some increased stress, and I think it's related to higher inflation meant a lot of things cost more, rents are high, interest rates are higher. You are seeing stress in that part. For mortgage holders, those indicators actually, they went down during the pandemic, and they've actually stayed very low. They're below pre-pandemic levels. So far, we haven't seen a big increase in stress among mortgage holders. Now, going forward, as you highlighted, the mortgage resets are going to get bigger for most of those households because they took out mortgages 5 years ago when interest rates were at emergency lows. The other thing we know about that group is that the size of the loan relative to their income when they took it out tended to be larger, and they don't have as much home equity as people who had a house before the pandemic. So those things all suggest that, even though the first 50%, we haven't seen big increases in, we haven't really seen much at all increases of indicators of financial stress, we could see bigger increases going forward. There are some mitigating factors. Most of these individuals have had a raise over this period. Their income's gone up. When you survey households, they tend to have more savings. So they do have some buffers. And certainly when we look at things in the sort of the base case, it does look like most households have the financial flexibility to cope with higher interest payments. Now, I would say two things. First of all, that doesn't mean it's easy. Canadians are making their mortgage payments. They're keeping up with their car loans. They're keeping up with their credits by and large. The way they're doing that is they're cutting back on their consumption. And we can see that in our sort of macro forecast, our monetary policy deliberations. Consumption per capita has been weak. So it's not easy, but it's not showing up at a big deterioration in their financial health. The second thing I would say is, look, higher Canadians do have higher household debt than many other countries. That is a vulnerability. And in particular, if the labor market was to weaken, if the unemployment rate was to go up considerably, people were losing their jobs, that would really start to impact their ability to make those payments. And that could be an amplifier if the economy weakened sharply. So, we certainly will be looking at the financial stress indicators of both mortgage holders and non-mortgage holders going forward. Certainly in the base case, we think there is the financial flexibility to cope, but there are risks.
Thank you. No follow-up.
Thank you, Jordan. Paul Vieira from the Wall Street Journal, please.
Okay, I might flip it to you.
I'm going to stay on that theme. You did say that households have the flexibility, they appear to have the flexibility to continue servicing that debt. But in that forecast and outlook, does your forecast and outlook incorporate a reduction in borrowing costs, i.e. interest rates? Is that why you believe households will have flexibility?
Well, the analysis you look at on the mortgage reset, so we use the market curve. So the market curve has some reduction in interest rates. So short answer is yes. If it doesn't, if that doesn't materialize, the risk will be bigger. If rates fall more than the market curve, it'll be lower.
On another point, in this report, you talk about the risk of volatility if market expectations for the path of interest rate don't materialize as expected. What is your opinion about market expectations for the path of interest rates right now? Do you think they're too timid, too aggressive?
We're really focused on our path of interest rates, and we'll have more to say that on June 5th.
Bon, alors passons maintenant à Olivier Ferron-Boissé du réseau TVA.
Oui, bonjour, merci de prendre nos questions. Vous avez parlé beaucoup de l'adaptation des ménages, des entreprises aux taux élevés. Est-ce que c'est un élément qui vous donne la confiance que les ménages et les entreprises pourraient résister plus longtemps si les taux devaient demeurer élevés plus longtemps que prévu?
Je veux souligner qu'il y a une grande différence entre notre rapport sur la politique monétaire et le rapport sur la stabilité financière. Dans notre revue sur la politique monétaire, l'emphase, c'est l'accent, c'est surtout sur le cas de base, la prévision. Oui, on parle des risques autour de cette prévision, mais c'est vraiment l'accent, c'est sur la prévision, le cas de base. Dans cette rapport sur la stabilité financière, l'accent, c'est surtout c'est vraiment sur les risques, les vulnérabilités. Et si ces vulnérabilités peuvent exagérer les effets des chocs. Donc, en termes de... Notre politique monétaire, c'est vraiment axé... L'accent, c'est sur le cas de base, gérer les risques autour de ça et prenez nos décisions autour des taux d'intérêt pour ramener l'inflation à la cible. Ici, le but vraiment, c'est d'aider le système, aider les ménages et les régulateurs, aider les institutions financières à gérer les risques.
Et peut-être sur un autre sujet, l'an dernier, dans le rapport, un des éléments qui sortait comme un risque principal, c'était l'endettement des ménages. C'était un moment où les taux montaient, puis on avait vu des baisses aussi dans l'immobilier. Je me demandais, depuis l'an dernier, comment votre évaluation de l'endettement des ménages a évolué comme risque?
Depuis l'année passée, il n'y a pas eu de grandes surprises en termes d'évolution de l'économie macroéconomique. L'inflation a baissé. Il n'y a pas eu une récession. Oui, la croissance, c'était faible, mais il n'y avait pas une récession. Et on a vu que les ménages s'adaptent à les taux d'intérêt plus élevés. Et à ce point-ci, c'est certain que certains ménages ont des difficultés, mais en gros, quand on regarde les indicateurs du stress financier, ils ont pas vraiment monté pour ceux qui ont une hypothèque. Qu'est-ce qu'on souligne ici, c'est que ça peut changer dans les prochaines 2 années à cause du fait que quand le changement de taux d'intérêt au renouvellement de ces hypothèques va être plus grand que c'était durant les 2 années passées. Ces hypothèques sont plus grandes en moyenne vis-à-vis le revenu de ces ménages. Donc, on peut voir une augmentation de stress. À l'autre côté, comme j'ai souligné déjà, les salaires des ménages en général ont monté, ils ont plus d'épargne. Et le message ici, vraiment, aux ménages et aux institutions financières, c'est de continuer de gérer le risque associé avec les renouvellements de manière proactive. Si vous êtes un ménage, vous savez que votre hypothèque va renouveler à un taux d'intérêt plus haut, planifiez pour ça. Mais commencez à planifier pour ça maintenant. Pour les institutions financières, c'est le message, c'est parler à vos clients et aidez-le, et essayez d'aider de gérer cette hausse d'intérêt.
Okay, let's go to Greg Quinn from Market News, please.
Good morning. I think we have a common theme here. I just wondered, public debate has been so dominated on the economy by what's going on in housing and affordability. This report surveys investors, and they rank the real estate sector as only the 4th most important risk in the financial system. You have the bank's commentary around resilience, which you've outlined. I mean, there seems to be a gap here between the public mood and what you're saying about the stability of the financial system. What's going on, and given what happened in 2008 around the world in property markets, is there complacency creeping in?
I'd make a couple of comments, Greg. I mean, first of all, we can't stress enough that there is a difference between looking at the overall system stability and acknowledging what is real stress in households and individuals. So by declaring that we see an overall low risk of instability in the financial system, it shouldn't dismiss what we know to be very real stress for individuals. So when it comes to sort of characterizing the mood, I mean, as the governor said, even if we're adjusting well, even if households are adjusting well, that does not mean that it's been easy. So, people are finding it difficult, and they're finding it difficult after years of dealing with a pandemic. So we all got through a pandemic, and now we're dealing with a difficult sort of financial landscape. So that's, I think that's probably what contributes to the mood or the feeling of, it doesn't feel good. So that's a difference between things being stable. In terms of the focus on housing being a big part of the narrative, I mean, I think the way you characterized it is probably true. Mortgages are attached to housing. There's a lot of focus on housing. The shortage of housing is creating a lot of pressure for households and for the financial system. So that tends to make us all focus kind of on people who hold mortgages. But what we tried to do in this report is sort of take a bit of a broader look and try and understand financial stress in different segments of the economy, in different segments of households.
Secondly, the report outlines geopolitical or macroeconomic risks. I think most Canadians identify the U.S. as our biggest trading partner or only neighbor. We know there are important elections coming up. We've seen tariffs and threats of tariffs from former President Trump and the current president, Mr. Biden. Is there anything you can say now about how U.S. elections might be creating potential risks in Canada's financial system?
I don't have much to say on that, really. I mean, I think a couple of things. One is, just more generally, if you look at the world, I'd say from a macro perspective, a financial perspective, relative to where we were when we were having this press conference last year, macroeconomically, inflation has come down in most of our countries. There haven't been recessions. Our targets are in sight. You'll also remember a year ago, it was shortly, this report came out shortly after the failure of SVB, the takeover of Credit Suisse. And while there's still certainly some adjustment in the financial system broadly, globally, to higher interest rates, since then, that has been evolving in a reasonably orderly fashion. So, I think from those perspective, some of those risks have gone down. More broadly, though, I mean, you look at the world, there's wars, there's geopolitical tensions. The world, the global geopolitical environment is fraught. And these risks are not things that are linked to the economic cycle. They're not things you can put in our models and predict the probability. And really what these, very uncertain, unpredictable things, these are why financial institutions need to hold buffers against unexpected events. They take provisions for credit losses based on what they see in the cycle, but, they have broader buffers for unexpected events. And, that's probably the best protection you can have against these unexpected events. I don't know if you have add anything.
Sure. I think that at a practical level, the way some of these risks might show up in financial stability comes back to one of the things we point out, which is stretched asset valuations, right? So asset valuations are always a function of fundamentals and then a certain amount of sort of sentiment or expectation. And if you get sharp changes in policy or really unexpected events, it usually affects that sentiment or expectations portion of stretch valuations. And you can get a sharp repricing, and then that's where issues like leverage create a sort of knock-on effect, right? So leverage amplifies a price change. And so back to sort of the earlier comment and the governor's comment just now. So how do you protect against that? You make sure you've got margins or buffers, and you make sure that you're thinking through the potential impacts of those changes, and that you're prepared if you get that large swing in price.
Okay, and to wrap it up here in the room, I've got Eric Hertzberg from Bloomberg.
Good morning. Are you surprised by the resilience of Canadian households in the face of higher rates? And what does this suggest about how the economy might be able to withstand higher rates than was previously expected?
Yeah, I just want to come back to this sort of comment that, economy can withstand higher interest rates. I mean, we manage interest rates to achieve our inflation target. I think, broadly speaking, the economy has evolved largely in line with our forecasts over the last year. Inflation's come down, and growth's been weak, but there hasn't been a recession. In fact, it looks like growth is picking up in the first quarter. So, we're really looking at interest rates to, our interest rate decisions are really guided by our inflation target. Obviously, we do look at the sort of the impact of our decisions on households, and part of that is through their financial stress. So that's why there is a link between, what we're talking about today and monetary policy. But as I said, to one of the previous questions, the difference between the FSR and the monetary policy report is the monetary policy report is really more about the base case. Yes, we look at the risks around that base case, but it's more about the base case. This is more about the tail risks. And what are those tail risks? What are the things that have changed over the past year? What are the things that are more concerning? What are the things that are less concerning? And the idea is that helps everybody focus on mitigating those risks, so those tail risks don't materialize. So far, as we've said, households are adapting to higher interest rates. The segment of the household population that is having more difficulty are renters. I think, renters tend to have lower incomes to start with, so they've got lower buffers. They've been particularly hard hit by inflation, food inflation, rent inflation, as well as high interest rates. You're seeing more indicators of stress there. That is certainly something that we need to keep an eye on.
And just to come back to Greg's question, I mean, the message in this report is not so we can all relax and not worry about it and be complacent, that's not at all the message. I mean, what we're saying is, here's what we see so far. Here are the things that we think are contributing to the fact that we haven't seen instability. Here's all the sort of proactive measures that households and businesses and banks and non-banks are taking. That's a great sign of the prudence in the Canadian financial system, and we would encourage it to continue. But it's absolutely not a message of complacency or that somehow we have interpreted all this to say that Canadian households are not finding it difficult to deal with the current situation.
Thanks. And as a follow-up, in the FSR, there's an indication that asset managers, insurers, and pension funds haven't fully revalued the commercial real estate holdings yet. Why do you guys think that's happening, or not happening? Sorry.
Well, I mean, there's usually events or conditions that trigger that revaluation. So the most obvious one is when you go to refinance a property. And so if you are borrowing, then that revaluation is going to happen when you go to refinance a property. If you own the asset, you might revalue it as part of a sort of annual look at your portfolio or something like that. So I don't know that the fact that that not every institution has revalued those assets is an indication of anything other than just sort of the timing of their processes. But that is something we'll watch.
Okay, we're going to go to the phones now. I'm just going to remind you to come off, if you're on the line, come off mute only, please, to ask your question, and then just go right back on mute as soon as you've finished. We're going to start with Mark Rendell of the Globe and Mail, please. Go ahead, Mark.
Thanks. Governor, you mentioned, one of the purposes of the FSR is to look back at how things have changed over the past year, what you're more worried about, what you're less worried about. So just asking directly on that point, I mean, what were you more worried about this time last year that has become less of a concern, and what are you more worried about that's an emerging concern that you didn't see last year?
Well, I think that, there's two things we really highlighted that we're focused on. The first is the ability of households, businesses to service debt. So far, that's been going reasonably well. Again, as we've been underlining, that doesn't mean it's been easy. Certainly what we see is that households have substantially slowed their consumption, reduced their spending to manage higher interest rates. But so far it's gone reasonably well. But we know that the bigger resets are getting closer. And so that is something we're watching closely. And then I would say that where more the new development on households is we have seen a more material increase in the financial stress of non-mortgage holders, principally renters. We've gone through that in some detail. That is certainly something that has changed over the last year, and that is something we'll be watching closely going forward. The other thing that we've highlighted that is changed and is of some concern, asset valuations are looking more stretched. Equity markets, credit spreads, and the danger is that if things get exaggerated on the upside, a triggering event could cause a sharper change in price on the downside. And particularly if things are overshooting on the upside, there's more potential for them to not just correct, but overshoot on the downside. And we are seeing more use of leverage, particularly among hedge funds. In this, the bond basis trade, futures trade, has become a bigger trade. And as I outlined earlier, this is providing liquidity to the market, is arbitraging, it's reducing discrepancies. That is all helpful. The pickup on each trade is very small, and so hedge funds, in order to really make this a viable strategy, need to do a lot of it. So they're borrowing. That borrowing does does increase the risk that if there was a rapid repricing, it could become exaggerated because margin calls, unwinding of trades could cause selling into a weak market and exaggerate the weakness. So, those are I would say the main things that have changed over the last year. Just to go back to some previous comments, I think the broader macro financial environment looks a bit better than it does last year. Inflation is lower. We're closer to our targets. Our economies have not gone into recession. After SVB, after Credit Suisse, there's certainly some more adjustment that needs to take place in the financial system to higher interest rates, but it's been reasonably orderly. The broader geopolitical environment, though, remains fraught, and so that is the backdrop that everybody's operating in. So those would be the main things over the last year.
Yeah, and you'll remember, Mark, the governor just mentioned it, but we were sitting here around this time last year, and it was right on the heels of SVB and Signature banks failing in the U.S. and Credit Suisse being taken over by UBS. And that was creating some stress in the global bank market. There was a bit of a shake in confidence, and that was showing up in funding costs for banks. And given that Canadian banks rely a lot on global wholesale funding, that was something that we had our eye on, and that seems to have largely resolved over the last year. So that was kind of occupying a lot of our thinking on financial stability a year ago, and not nearly as much this year.
Got it. Thank you. And in terms of, as you say, we're entering a period where we're likely going to see bigger mortgage jumps as people reset over the next 2 years. Can you just kind of go into what that means more broadly for the economy and for consumer spending, and how that ties to the path of interest rates? I obviously don't expect you to tell us where interest rates are going, but large resets are going to, I can only presume, have a significant economic impact. So if you can just kind of unpack what that might look like and how that features into specifically thinking about monetary policy.
Yes. So, mortgage holders are, about a little less than 40%, I think, of Canadian households. So for that 40%, roughly half of them have already, half those mortgages have reset. And as we indicate, while that hasn't been easy for those households, by and large, indicators of their financial stress have remained quite low. Going forward, bringing it into sort of the macro framework, the base case is that those households, when those renewals happen, it is going to be difficult. I think many of them are planning for it today. They're already reducing their consumption today, increasing their savings to try to get prepared for that reset, and that's a good thing. But it does suggest that the effects of higher interest rates take some time to work through the economy. So they will continue to restrain household spending, and that is something that obviously we're taking into account as we think about what interest rates need to be to get inflation back to target. In fact, mortgage holders are one part of the economy that we have particularly good data on. Through OSFI, if mortgages that are held at a federally regulated financial institution, we know the whole distribution of mortgages. We know the resets. We know how we know when they're going to happen, and so we can get pretty good estimates of the macroeconomic impact of that. The point of this report is that is a vulnerability. Even if it's been going reasonably well, and even if we think the base case is most households will have the financial flexibility to deal with that, even if it's not easy, there are risks. And certainly if the economy was to slow much more sharply than we have into our base case, if more Canadians lose their jobs, the unemployment rate goes up, all of a sudden that stress, that vulnerability is really a risk of crystallizing. More households won't be in a position to pay that mortgage, particularly given the larger reset. So it is a vulnerability, and the point here is households, banks need to get ahead of that. We know it's coming.
One of the things that may not be obvious and we've maybe never described is despite the fact that we only publish a financial stability report once a year, we don't only look at financial stability once a year. We look at financial stability at every monetary policy decision. And so the information that you see in this report is something that we're looking at all the time and that we feed into our policy rate decisions. In fact, the forecast that the governor just talked about, our ability to look really at a level of detail about mortgage renewals and how they're going to affect income and households, is something that is part of our forecasting process. So these are two areas of the bank that sort of work closely together.
Okay, I know we've gone over, but I've got just two names left on my list, and I hope we can get through them pretty quickly. Craig Lord from Global News, please.
Hi, good morning. Do higher interest rates typically hit renters harder than Canadians with mortgages, or is there something different happening in this cycle?
Well, I think it is typically true that renters, on average, tend to be more cyclically sensitive. They tend to be more vulnerable to the cycle. Renters generally have lower income than mortgage holders. They tend to have lower savings, lower buffers. And so particularly in a situation where rents have gone up a lot, I mean, rent inflation is roughly 8%. Also, although they have certainly come down, over the past 2 years, food price inflation has been high. So energy prices went up considerably. So many of the necessities, your rent, your food, your gasoline, the share of their consumption basket that is made up by necessities tends to be larger, and they have less buffers to absorb. So they, for a variety of reasons, they have been harder hit. They've also, yes, been hit by higher interest rates if they have a car loan or if they have a consumer loan. But I would stress that the confluence of events that are particularly affecting renters is broader than interest rates. Yes, interest rates are a factor, but they're certainly not the only one.
It's a really good reminder that interest rates are one thing that's affecting households, but so has inflation, right? And so that's why we've stressed how important it is to get inflation down.
Yeah.
And so what overall does this financial stability report tell you about the need for interest rate relief right now in Canada, particularly for those renting Canadians?
Look, as you know, as the senior deputy governor said, you know, we look at financial stresses as we feed into our interest rate decisions, and you know that is one set of information that we consider along with everything else we're looking at. Where that information is particularly helpful is it gives you a sense of how much traction are interest rates having, how much are they biting, where are they biting, who's being affected, and that is one thing that helps us figure out the path for interest rates that's consistent with getting inflation back to target. It's not the only thing, but obviously the household sector is the biggest sector. I mean, it's the biggest sector of the economy, and you know, the reason why it's so important to get inflation down is so that households don't need to worry about big increases in their cost of living going forward.
And just finally, Barbara Schechter, Financial Post.
Yes, hello. I just wanted to ask a question about contagion. There are a couple of things in the report that you talked about. One is the smaller banks struggling a bit more with mortgage renewals, maybe because of timing. The other thing is leverage. You talk a lot about leverage, and if we recall from the 2008 financial crisis, that was a huge thing, and it led to contagion. And this is something that OSFI's raised as well. So can you talk about where you see potential risks there?
Well, maybe I'll start with the first part of your question. We do see a difference in stress indicators, particularly around credit performance, so arrears or impairments in small banks relative to large, but this is relatively normal. So our small banks run a different business model. They serve a different market. They tend to have shorter term loans, more variable loans, and they often serve what would be considered in the credit market at least sort of higher risk borrowers. And so it's typical that you'll see a little bit more stress in their credit performance. So I don't know that this is, necessarily alarming or some sign of contagion. In fact, in some sense, if you look at sort of the turnover in their book as being quicker, and we don't see really elevated levels of stress, that's one of the things that gives us some confidence that even as mortgages renew in the larger banks over the next 2.5 years, we don't anticipate a big jump in stress indicators. On leverage, I mean, I think we've talked about this in response to a number of questions. Leverage is usually there to amplify profits, but it works the other way around too. It amplifies losses, it amplifies volatility. And so wherever you see leverage, you have a bit of a vulnerability, and you need to manage that. You need to anticipate what would happen if the trade or your motivation for leverage turns the other direction, and make sure you have a buffer to protect you against that.
Yeah, I'll just end by emphasizing that, I'm glad you raised that question, because we're looking at financial stability through the lens of households, businesses, banks, and financial institutions. If one thing goes wrong, obviously it's not good for those people, but it doesn't typically create a financial stability problem. It's when there's a few failures and you get the interconnections between the system, the contagion that is created starts to amplify the problem, and a manageable problem becomes an unmanageable problem. And really that's the focus of this report. And, by trying to, we changed the name of this report to the Financial Stability Report to really put the focus on where who are the key players, what are the key interconnections, and what are the sources of interconnectedness or contagion that could cause a problem in one place to amplify and make a bad situation a lot worse. And so what can we do to try to cut those and really avoid those? The best thing is to avoid the problem from happening, from even getting started. But the reality is the world's an uncertain place. You can't count on nothing going wrong. You have to be prepared for things are going to be going wrong. You need to make sure you've got sufficient buffers. You need to make sure that the connectivity doesn't over-amplify.
Any follow-up?
Just
Go.
quickly
Please.
follow up on that. Yeah, I just wanted to follow up on that in terms of is there anywhere where you see the growing leverage amongst pensions and hedge funds, for instance, bleeding over into large Canadian banks or something of that nature?
Look, I think we, with respect to households, I think we've discussed those risks extensively. The potential, we don't think there's a huge potential for that to spill into financial stability. Banks are managing, are proactively reaching out to their clients. They do have healthy capital and liquidity buffers. Leverage is not high. With respect to financial markets, yes, I think we did highlight the increase in leverage in the hedge fund sector for a reason. We did provide quite a bit of analysis around commercial real estate, in particular the office building sector segment, which where valuations are low. There is some more adjustment to come. So, we don't expect that there's going to be problems here, but we do want to get people focused on making sure they are managing the risks because there are risks.
Okay, and that's going to conclude today's press conference. Apologies for going long there. Thank you to the governor and to the senior deputy governor and to all of you for joining us. We'll see you again soon.
Thank you.
Thank you.